Danger, danger, high voltage, commercial real estate in peril. That's certainly what has been talked about on the Bloombergs, the CNBCs. But are we conflating commercial real estate, all the asset classes into one? I think so, but there's definitely a lot of blood out there ahead of us. A lot of the sharks are certainly smelling it, and there are a lot of owners that are in rough shape right now that are looking at loan expirations. But how does that affect multifamily? How does that affect the commercial real estate industry? How does that affect the macroeconomy? We're going to talk about it here on the Gray Report. So if you're a multifamily investor, active, passive, somewhere in the middle, you're in the industry, you're in the right spot, stick around, subscribe, give us a comment as we're talking about all this stuff. Every single week on the Gray Report, we're breaking down all the latest research reports, news articles. Matt and I are throwing out some original commentary and opinion that you're not going to get anywhere else. Stick around for the whole episode. We're going to get into it. All right, let's go. Welcome back to the report, ladies and gentlemen. Joined again, co-host, producer, Dr. Matt Bosnagel, Director of Communications and Marketing here at Gray Capital. Matt, fascinating pieces on the Gray Report, but not only on the Gray Report, across the national finance media as well. I've seen an incredible uptick, really in the last several weeks, maybe the past month or so, but especially in the last week or so, Matt, conversations related to this avalanche of CRE debt. Yeah. And the idea that commercial real estate is going to be the next foot to drop in this ongoing saga of inflation, the economy, impending recession, hard landing, soft landing, whatever we're in right now. We've been talking about this for over a year, man. The difference is what could be coming up, all these bridge loans. Is the national media getting it right?
I think that they're confusing. I think that if you ask someone what commercial real estate is, they wouldn't say multifamily. That's the first thing.
Yeah, offices, right?
Yeah, exactly. And the second thing is they may not be wrong if it's about offices. Yep. I've been saying like there's going to be a lot of pain that's associated with, even apart from this current vulnerable environment that we're in with the banks, where like it seems like any scratch could kill them. The new remote working situation means that the office is gonna transform, if not already, trying to transforming. The question is how much pain are we gonna have? Yeah. Because I think something big is gonna come. It would be foolish to think that we didn't transform office culture and then the office real estate wouldn't be affected. Yeah. I don't think we can turn them all into something else either.
And even if the culture, the work from home culture over time doesn't change as much as we thought it may have in 2020, it may not revert back soon enough before mortgages are due, and pricing is reset at new valuations, and loan to values are all upside down right now, and it's not going to necessarily avoid owners needing to bring capital to the table if they want to hold on to their deals, or they're going to let them go. There's going to be a lot of keys handed over to the bank, unfortunately.
Yeah, at least it seems like what we're seeing in the multifamily market is no one's moving. Especially if it's a seller is in a little bit uncomfortable position, they're not going to move at all. They're going to wait as long as they can. It seems like there's all this waiting done, and I'm curious to know how much of that is happening in the office market, where it's like, okay, we're just going to hold on to this as long as we can until something's going to really start to really burst.
I mean, it makes sense. A lot of people are playing pretty close to the vest right now. No one's gonna like jump up and down and say like, hey, we're in trouble, or we think we're gonna be in trouble. Everyone's trying to figure it out right now. And for the last up until a month ago or so, everyone was like, well, maybe rates are gonna be lower, very low at the end of the year or early next year, and it's gonna be okay, and we'll be able to refinance. But as we've mentioned in previous episodes, that idea, that dream is starting to kind of wither away, or at least be pushed out to multiple years. And if you've got a loan that's coming due, you're not going to have too many options. And unfortunately, a lot of banks that you would like to think would be able to work with borrowers, they're going to be looking at a lot of losses on their books and marking down values, and they may not have the flexibility. And I think it's going to be relationship dependent and very much bank dependent. Yeah. And then it comes to the question of, what other systemic, problems do those kind of surface level That's kind of service level, underlying assets. What's connected to that? What kind of derivative instruments are all tied in together? We all know the Big Short story, great financial crisis, all of these leveraged derivative products, and they didn't go away. They kind of got relabeled in a couple different ways, but they certainly did not go away. And what I keep thinking about is the confidence of a zero rate environment. That idea that we're going to have low rates because persistently forever, maybe, because there's no way rates can go up. We don't have any inflation. We haven't inflation for years, and that it's so unlikely the government isn't going to be able to service the debt, which is a problem. But but the fact is rates are higher. And how many models representing trillions of dollars, hundreds of millions, trillion, whatever the number is, were based on these models of rates being in a certain range, and would not have forecasted rates where they are, and certainly not have been able to forecast the volatility and the rate of change. And let's go back to another movie, but it's margin call. It's a really this is what we're talking about. Is that like they would have anticipated it's the volatility that broke the model and broke the system, and the compounding because of the leverage, layer upon layers of leverage, creates these massive losses. And that's what I'm more concerned about from a systemic standpoint. And it's really, I don't know all those. I'm not smart enough. I don't have the insights like into all those layers. Like I can multifamily and the financing that surrounds it, and then general concepts of the macroeconomy. I can happy to talk about that all day long. The rest of it I don't know, but I know enough that there's could be some things, some black swans.
I mean, look at you driving to work, to and from wherever you go. You see these big old office buildings. If that's not a huge, that's a lot of money to build an entire office building, and to think that maybe it's 40% occupied now. And that's a lot of money that's being held by someone, and to get that value wiped out, there's going to be some pain.
I mean, there's going to be some buildings that are torn down. We just don't need all these old office buildings, maybe. But we still need places to work. I just don't that we've talked.
That's true. That is like a little catastrophe.
But if you're a business and you want a place to work, you're not going to go to an old 60s or 70s, 80s vintage office building with low ceilings, no amenities, carpet floors, and the story. I mean, like our office, we're full. The whole building is full, but it's an old building, but it's completely renovated, fancy, and
that's that's the big narrative of the office market too. Is there's a lot of interest in new stuff.
Flight to quality.
But no one wants to no one wants to live in a old dingy office building when they have got choice. Do you want to go talk about the Moody's Analytics article first, because this is the topic that we're talking about.
Let's jump right into it.
The title is "CRE is vulnerable, but please don't overlook the details." This is we were talking about there's a difference between are your properties vulnerable, or are those in as an investment, or is it creating vulnerability? And I think for the office properties, both. Banking turmoil, rising interest rates have put CRE in the spotlight, specifically the office sector, just like kind of we talked about. The GDP has been revised out to 2.6%. PCE growth has decelerated to 0.3%. Inflation expectations have declined sharply. I italicized this in my notes because it's important to note that maybe if inflation's going down, is that going to? I still don't think that we're going to snap our fingers and get low interest rates again. And there is so it's still maybe some big troubles on the way, just because of the lagging effect of all these loans coming due.
I mean, I think we've been in kind of a stagflationary environment for the last 6 months, and I think that we're really going to experience some stagflation of some moderate inflation, but just some anemic growth for a period of time. Now, how anemic? That's yet to be seen. We're starting to see the cracks. I know we've seen, wages have been growing. I think we get some hourly wage information tomorrow that's going to be released on Friday. It's going to show some wage increases. But we've been adding less and less jobs, and some of the recent data has shown hiring has slowed, some weakness. Still tight, still strong, but a weaker job market, which is what the Fed wants to see, and it's a lagging indicator. So we could. This week, and again, it's going to be different 3 weeks from now, Matt. But right now, everyone's like, no, recession is certain. 3 weeks from today.
Yeah.
Mark our calendars. No more recession in sight. And it's all like yield. You're looking at the yield curve.
Yeah. It's interesting to see how much we've been talking about interest rates and the vulnerability and stuff. And we've been, talking about maybe the effect on the greater economy. More and more people are talking, especially the tech sector. And it's not just like this first wave of layoffs, but these high interest rates are a completely different environment for tech companies that used to just be able to kind of grow their way to valuation, but now they suddenly don't have, like, the runway is gone. Then no one wants to make a decision with high interest rates, and there's going to be, I see, and this is my,
I heard Google had a layoff 40 masseuses recently.
We'll got to talk about that afterwards.
Yeah.
No, but I do, these tech companies are having Facebook.
Sorry, I was going to say, I don't think actually masseuse is the proper term. I think it's massage therapist.
Oh, okay. All right.
Doesn't mean to offend it.
Yeah. The Facebook has this era of efficiency. This is, I think, maybe a different era. You think back to the past 15 years, was the low interest rates and tech, and you could have all the amenities. It's Silicon Valley. The show Silicon Valley.
It's like, that doesn't make sense. Like, that never made sense, right? Everyone's like, what?
I know.
Free sushi, massages, like everyone gets to just not work at the same time. Like, it didn't make sense now, and now it's just like, what, chickens are coming home to roost, I believe is the term.
And for a VC or for an investor, sometimes it would make sense if you have low interest rates that you have that money that you can kind of wait and see which one of these investments is going to work, or you have a lot more wiggle room. And that's what seems like the whole economy had a whole lot more wiggle room. Now you make one mistake, like I said, one scratch in a bank,
it's real,
and then you've got, you're bleeding. And you can't staunch it unless there's a crisis. And that's why I think this office situation, even if it's a small scale crisis in the office market in a certain city or a certain bank, it could, create a little bit of a contagion effect. And this report from Moody's, it's actually a pretty good size report for some of the stuff that Moody's typically puts out is a little more briefs. They have a section on vulnerable office markets, and they talk about the metros with the highest and lowest pre-1980s class office stock. And so, which are the places with the old buildings, which are the ones that are the most vulnerable to an economic slowdown too. And, this is good this is good information for office investors, but it's also, I think that it's worth talking about this specific real estate sector because it could have such an outsized effect on the market. And, maybe I'm being overly dramatic, but it seems, it's a lot of value are held in this, and if that value is destroyed, then I don't think that we're going to get out of this without some.
It's a lot of institutions too.
Yeah.
Institutions have always historically liked investing in office buildings, especially in prime markets and CBDs and insurance companies, and maybe this institutions can better weather the storm. But what I'm curious, Matt, is, so what's the fallout? Because obviously, it's not going to be completely contained.
Yeah.
We're not going to be able to put office in isolation. There's going to be some bleed over. The macro economy, we kind of talked about who knows, the black swans, but multifamily itself, is it going to get lumped into, office, Matt? I mean, what are your thoughts on how take the fundamentals of multifamily out, other than like on strong footing, other than just interest rates, but how do investors view multifamily in the context of offices? Does multifamily look that much more attractive, or is like all CRE gonna look dangerous and risky?
See, I bet if it causes anything, it could cause a general economic downturn or something like that, where a lot of people have a lot less money now, whether they want to invest or not,
and just less credit.
Yeah, and rather than like being part of people's decision-making process, it may not be as much of like as an alternative or not, but it may just be one that just kind of caught in the crossfire. And maybe multifamily has to deal with stricter bank lending terms because, they're trying to kind of like mitigate risk or tighten their belts. Yeah, keep that plane away from me. But yeah, like I think that's it.
Like, I'm wondering, like, are there gonna be like office investors are gonna be like, I have to sell my multifamily deal because I need to raise cash for.
Oh, that would be great. Yeah. But when it comes
to be good or not, I don't know. Depends on if you're.
Yeah. When it
where
comes to demand, though, I think that demand from renters, I think that we're in a pretty good spot.
Yeah, I mean, and getting on multifamily, we have seen some green shoots, as they say, in the spring. Part of it's a spring leasing season. I think there's some fatigue of not making decisions. People actually need to decide, if they're going to rent something. They're moving around. And we've seen this first anecdotally, and then look at the data. Anecdotally, our portfolio, Matt, we've seen strong performance across the board the last couple of weeks. I mean, a lot of traffic, a lot of leads, a lot of leases.
It was very gratifying. There were a couple reports, we talked about it before, that just came out this morning. We're not including officially, but maybe we'll reference them. This from RealPage and Yardi Matrix, both showing solid apartment demand, and particularly, I think it was RealPage, consistent rent growth.
Yeah, no, Jay Parsons did a nice LinkedIn post, as I think the whole multifamily CRE market follows his post. But I mean, laying out that we've had some really good signs of leasing activity on a national basis from macro. Just looking at the data, Paul Fiorilla from Yardi echoed a similar statement. So there is some positivity in terms of leasing traffic. Absorption is positive. I think in March.
Good. That's what I remember.
Report. So from basically, I forget how many months in a row. I think 8 or 9 months of negative absorption. We're actually at positive absorption territory. So that's really, really good. We absorbed something like 18,000 units just in March. Now let's see if we see a trend. But that's confirming the some of the, I guess, hypothesis and some of these early indications that we saw about a month and a half ago of being, okay, there are some positivity, some signs, not enough to make any conclusions. Now there's enough information to make a conclusion of, no, this was a good month.
Because we were down where, the month over month rent was declining a lot. Then it started to decline less and less and less. Then we finally had a month of barely positive, and now we have even more positive. So we are following a long-term trend of accelerating rental growth. But it's nice to have these 2 or 3 solid months of positive rent growth. That really puts the lie to a lot of articles there. I think there was 1 or 2 articles mentioned that we covered today about, this slowdown in rent growth. Well, no, now it's pretty much back to normal. It would be facetious. I don't know. It would be disingenuous to argue that that rent was, cool or anything. It's definitely within norms, maybe a little above.
Yeah. So I mean, positive signs fundamentally for multifamily. At least on, again, the leasing side and the day-to-day operations, but on a market of buying, selling, refinancing, that's where it's. There's not a clear picture. I mean, I can paint you, I can tell you a story, Matt, of where there's going to be all this blood in the street. It's going to be really bad. I can also paint a picture where it's really not that bad. And if you had to put a gun to my head, I think there's going to be a very brief opportunity for some deals, and there's going to be some distressed opportunities. That's going to be less than. It's not going to be everything by any means. It's going to be pretty selective. Brief time, and then I think there's going to be a lot of money that comes back in. The Fed's going to come in, lower interest rates, and then fundamentals in multifamily are going to look good. And I think there's going to be so many buyers that are not going to let the price go so low. And if they do, there's going to be buyers. I mean, we're not the only ones that are ready to go.
And this is happening kind of in the home buying market too.
There's a lot of similarities in general.
And you brought up margin call, and one thing that happened at the end of that movie is they found out something terrible was happening. They had to unload all their stuff. They did it quick. Once you find that, once these sellers may have that realization, or come to that change of heart, speed is going to be of the essence, because they want to staunch those potential losses as quick as possible. So,
the way that they did,
if we show this video,
probably, but it's on YouTube already.
Do you care to know why I'm in this chair with you all? I mean, why I've earned the big bucks?
I've reenacted this a lot.
That's great.
I'm here for one reason and one reason alone. I'm here to guess what the music might do a week, a month, a year from now. That's it.
I say it in the shower.
Nothing more. And standing here tonight, I'm afraid that I don't hear a thing.
Oh, no. Yeah.
What have I told you since the
hear
first
it.
day you stepped into my office? There are 3 ways to make a living in this business. Be first, be smarter, or cheat. Now, I don't cheat. And although I like to think we have some pretty smart people in this building, it sure is a hell of a lot easier to just be first.
Sell it all today.
Is that even possible, Sam?
Yes, but at what cost?
At what cost?
Yeah.
At what cost? So if you haven't seen Margin Call, watch the movie. It's very timely, and Big Short is good too. But Margin Call specifically was to get into more of the interworkings and how all the CDOs and all the MBS product packaged and how it's on their books. And history is rhyming quite a bit.
Yeah, not that I think that anyone should take investment advice from a dramatic scene, but
Well, yeah, I wouldn't take investment advice from any of this, Matt.
exactly. This is
Only.
yeah, very very true. But I think that psychologically and kind of in terms of profit, these are companies and individuals that can move fast when they're highly motivated, and nothing motivates someone. Avoiding losses is more motivating than getting gains. You want to really, once you realize those losses in your head, then
it becomes much clearer.
Yeah, it becomes much clearer.
Now, the difference between that situation and the situation we're in now, at least with multifamily.
Mm-hmm.
Office, maybe that's exactly the case.
Yeah.
But multifamily, it's, they had product, and their issue was they had, dog crap on their books that they were packaging up, putting a bow on it, and selling it.
Yeah.
Something that was great. And that's not the case with multifamily. It's a lot of good stuff that just because of, financing and rates are a little bit distressed, but, with some creative financing could probably be figured out.
Yeah.
Now, there are some bad multifamily loans out there. Just because I have had enough conversations with lenders and mortgage brokers who would tell me that they would basically commit mortgage fraud to, get the highest proceeds, Yeah, there's definitely that stuff.
Some in the cheat category.
Definitely some in the cheat category, and it's like no thanks.
Yeah.
That's how you're going to pitch me of like, well, we'll commit some mild mortgage fraud, we'll get your proceeds up. Well, that's forever enough. But a lot of people went down that road. How much? No idea.
Hey, I've got an idea.
Yeah.
If it was a bad idea to get a floating loan a year ago when rates were low, now let's get a floating loan now when rates are high. Great idea, right?
Yeah, right on the way down, maybe. I mean,
Right.
the problem with that is, and it's a good question. I mean, because there's some advantage to the floating rate loans, but there's risk. And right now, it's just the caps that you have to buy on the floating rate loans.
Okay.
You have to buy, cap 2 or 3, at least typically 3 years, and it's priced on the forward curve, which is crazy.
Okay,
So you're paying. I mean, like we looked at, I forget what the size of the cap was for the size of the loan, but I mean, just the cap itself, it was like $1 million.
Yeah. Wow.
Now, if rates declined, your escrow would come down, but the value of that cap also would go down also, so you'd lose money.
Oh, wow.
Or at least that you wouldn't.
Yeah. That's interesting.
Because we have made money with our caps as rates have increased.
Yeah.
The value of
Okay.
the cap's gone up quite a
Okay.
bit.
That's interesting because I remember in a past Gray Report episode long ago, we looked at a chart that was kind of like, I think it may have been forward curve, where once these interest rates hit their highest, there were people that were banking on, that were kind of fixing it right at a very high rate. And it was but it's part of the mechanism of getting that loan.
Yeah.
Unless
The agencies require, bridge loans don't typically require, but longer term variable rate
Okay.
loans, required if some sort of interest rate cap or some sort of interest rate hedge. So
they can't figure out your way out of it.
No.
I thought there was a trick. Sorry. It's one weird trick.
It's one weird trick the Federal Reserve doesn't want you to know.
Yeah.
Where do you want to go next, man?
You've got that article up here on apartment building sales. Let's talk about it.
Wall Street Journal, apartment building sales dropped 74%, the most in 14 years. DSC Quattro, Matt. That's
yeah. So this is our article is targeting a broader audience, and it's not the plugged in experts that follow the Gray Report. So while we know all about this apartment sales slowdown And we know that it's in part due to higher interest rates, banking turmoil, and slowing rent growth, quote unquote, slowing. Wall Street Journal is telling its readers, and this is a signal that this issue of apartment building sales is becoming more prominent. No one was talking about any kinds of apartment building sales when there was,
Well, this is another example of this whole idea of people are like seeing commercial real estate now lumping multifamily into that as potential next shoe to drop.
Yeah. So there's some places, I think the rent growth is a little bit of them kind of like following the narrative a little bit too closely, and they let it, but that's okay. It is kind of incontrovertible proof of slowdown in sales, dropping 74%. I believe it. It does. It certainly seems really slow, and that jibes with my general understanding. I'm not sure exactly what data source.
There's 20. It's CoStar.
Okay.
And I believe it's the lowest since 2013. I believe multifamily volume, which obviously I don't think it's adjusted for inflation, so it's even less than that. Which makes sense. I mean, it all makes sense.
Oh yeah.
Again, and if you're a listener to the Gray Report, this is like not surprising.
And, I make these things like, oh, it's in the movies, it's here. But like people they are generally behaving very similarly, whether it's someone speculating on a movie or whether they're talking about it in the apartment buyers and sellers are acting similar to residential buyers and sellers. They're seeing these high interest rates and they're like, I don't want to sell if I don't have to. It says in the article, broader residential housing market is experiencing declines in home prices and sales. There's a Marcus and Millichap report, short research brief that talks about in housing in general, there just aren't enough people selling houses. Everyone buys them.
Well, yeah, there's not a ton of inventory. There's some.
Yeah.
I was on a property tour today talking with a broker, and they're doing BOVs. I think they did like 20 BOVs last week, 20 BOVs this week.
Okay.
And I was like, are these people that need to sell? He's like, no, not really. These people figuring out what values are. People don't know where things are.
Yeah.
They don't have a ton on the market though. It's like we've got a couple deals here and there. Then the brokers that always had like many listings have like 1, 2, or none.
Yeah.
Some deals are getting done still though. But it's few and far between. And as we've talked about, just the gap between buyer and seller right now is too wide, and there's too much fog of war to be really confident.
Yeah.
And that I think that's going to persist for a period of time. That being said, I think that there's going to be a great opportunity because I don't think that every part of the country is going to be as affected as everywhere else. And there's some assumptions out there, and there's the ways to get creative. We're also just being the great capital. We're just being trying to look ahead and like what do we feel comfortable paying, and having a good sense of the market. We feel like, right, if we feel comfortable, I think that's really where the market is. Just from experience. And the brokers kind of are basically like, here's how it works. If you're talking about another deal that's not their listing, they agree with you on price.
That's good. Yeah.
They're like, no, exactly. Because like we'll talk to a broker that didn't get a listing, and we're like, yeah, we were penciling in at $40 million. They want 60. And the broker's like, no, our BOV was at 41.
Yeah.
You guys are right on.
Yeah.
And we're like, okay, good. That makes us feel better because we're no mean to be offensive, but like we can only pay $40 million for this.
Yeah.
We can't pay a penny more.
And that's what's
like, can you get the 55? We're like, no.
Yeah. And that honestly, it's so funny that you mentioned that, because I was again, this is this Marcus and Millichap housing article. I was thinking about like in the residential, and just the home buying everyday Joes that are buying and selling their homes, it's almost like there's an artificial price floor where, I do want to buy, but I can't buy at above this number.
Well, yeah, no, because it's absolutely the case. Is like the more your monthly mortgage is so high, it's like it is not possible.
Yeah,
it is not. It doesn't work.
And I think there's nothing to be said except for like, these prices haven't been discovered. This is a market that is not matched right now. I don't know what the vocabulary is, but like there's a clear, it's not working right. And I mentioned this, I think a couple weeks ago, a few more, about this like idea, there's going to be a cost to this. I don't know where it's going to show up, but the idea that these opportunities are being missed is unfortunate, and it's going to be born somehow.
Here's the silver lining. Here's how things will get better, man.
Yeah,
just be an optimist. We've seen some the green shoots. We've seen some trending performance. If that trend continues, there will be more interest.
Yeah.
if rate increases at the Federal Reserve plateau, which they may in the near future, that will give at least a sense of direction, at least where rates are. You can just predict. You can like model where your rate will most likely be, maybe, or at least within a range. It's not going to go up 100 basis points before you close. That will give buyers confidence to move forward, put some money down, and move forward on a transaction. If you see those two things happen, then it's the buyers who are going to have to be speculating against each other of how much potential growth they see, what type of returns they want. But we can at least all like agree on a couple truths, like, okay, where are rates going to be, and the sort of the direction of rent growth. Yeah. Because right now you've got buyers who are like, no, I'm up, like zero rent growth, none. Yeah. It's got to work. I'm falling closer to that camp of like, it's got to work like that. Now, will there be rent growth? Yeah, there's going to be rent growth of 10 years, but like, it's got to work with none. Yeah. That's like almost impossible to do right now, to be honest. But then you're going to get eventually some people, if, okay, we know what interest rates are going to be, we see some growth, people are like, well, no, maybe there's going to be 5% rent growth. Maybe there's going to be 4% rent growth for the next couple of years. Maybe it's just 3%. But all of a sudden you can factor in a little bit, not even aggressive assumptions, but like growth-oriented assumptions that are based in some kind of trend rather than throwing a dart at the wall, because everyone's just throwing a dart at the wall right now and rubbing two sticks together to like see what happens. Yeah, well, and there could be people. Is that even an out? Well, I mean, that's fine. They're making guesses, and I think maybe another guess is like, well, there is appetite for buyers. It's not to be out. Maybe if the buying appetite comes up, then valuations go up, and then we just reach this cap rates just go down, and we just are at a different equilibrium. Or I agree. It's like where are cap rates? No one knows. How much they matter? That's an ongoing question. It's all relative to the market, anyone's perception, and just kind of going rate for yield relative to other investments. Right? But we all knew that sub 4 cap rates weren't sustainable. Well, they were only sustainable at a zero rate environment, and now that we're in a real rate environment where rates probably going to shake out around 5 or so. I think cap rates north of 5, I think, make a lot of sense. Yeah. I don't see how they don't, to be honest, over the long-term average. Now, if rates are down in the 3 and 4% range, then I think we can have cap rates in the 5%, 5% range or so. Yeah. But I just don't see 5 caps in a 5 rate environment. Well, we'll have to see what these builders are going to do then. Are they going to? Yeah, well, I mean, the new supply coming into the market, if they are they going to refi? Yeah, that's. I mean, they're all in construction loans. Yeah, and 8% now, 9%. So that may be the way that things come out of it is there are almost 1 million units of apartments currently under construction. Yeah, and I don't think that most developers are in the business of maintaining and owning an apartment building long term. Even if they are, they're not on the permanent debt yet. Some have forward takeouts, like already negotiated, but I don't think that's the majority or a large percentage. So cast aside the idea of someone making that getting on the wrong side of a floating rate loan. These developers who they didn't make bad bets necessarily. They weren't they were just doing the same thing that they were doing, and now. So should we be afraid, Matt, or should we be excited? I think we should be excited. Yeah, because I think that it means that there is going to be a mechanism outside of Jay Powell's, decisions that should, brings at least some kind of, and it's instead of residential construction, which seems to start and stop a little bit more quickly. These projects are kind of already locked in. Some may be abandoned, but not with that cost. And that's another thing that abandoned sunk so much. A lot of sunk costs. So that may be a small release valve. But. Yeah. No, I think a lot of groups, us including, are starting to smell blood, but we can't find the blood. Yeah, but we're smelling it. And then there's groups out there that are starting to bleed and are getting worried. And I am very confident there's going to be a massive amount of wealth transferred. Yeah. In the next year that's a good point. Yeah. I don't know who to where, how, but there are going to be certain places where if you put the right buckets out, you're going to gather a lot. Yeah. Yeah. And that's the thing too, is I was mentioning this office market catastrophe or whatever.
A lot of people are going to lose a lot of money, but that's, when the market moves at any point, there is always some profit to be had.
And their side of the trade.
Yeah.
And which side do you want to be on?
Yeah.
And that's where I think we have to get creatively as, real estate investors of being comfortable saying that, what we've been doing is not the right thing to do.
Yeah.
Forward.
Very
I'm
good
not saying
point.
buying apartments, but just the way that you were doing it.
Yeah.
And I've asked myself this, there has to be a scenario where it's like apartments should not invest. No, don't do it.
Yeah.
I'm not saying that right now by any means, but if you're not open to that idea,
Mm-hmm.
you could just put yourself in a just horrible position. Or
Yeah.
You've seen the show Billions, Matt.
No, that's one of the ones I haven't seen.
So there's a great, I forget who said, but there's basically a line saying that, the sign of a good trader. I'm not a trader at all. I'm so bad at it. Tried it once, but it's the sign of a really good trader is not one that like just admits that they made the wrong trade, but the spot that they made the wrong trade early enough along and do the opposite trade.
Yeah.
Go complete opposite.
Yeah.
And just to be able to turn your convictions around, because it's so hard to say, no, I am completely wrong about that.
Yeah. Yeah.
I'm going to go full on in the other direction.
Yeah. That's interesting.
And again, I'm not saying that with multifamily, but there's going to be these opportunities, whether it's, in distressed office.
Mm-hmm.
And is that opportunity in buying those distressed buildings, converting them? We know that's a challenge. Demolishing them, just building, land grabs at incredible, low basis. You knock the thing down, you sell the dirt.
Yeah.
Or are there opportunities to, take advantage of, shorting different, financial products, selling short, selling options, even buying, some, insurance products against, mortgages, mortgage default swaps, things like that. Again, things that are outside my pay grade, I don't really fully understand how they work, but you can see opportunities moving in a certain direction that is not necessarily normal or something you'd be excited about because it's not good. But as you said, there's going to be a lot of money that's going to be lost.
Yeah.
And it's not like money can certainly be destroyed, with, higher interest rates, and money has been destroyed recently with the Federal Reserve.
Mm-hmm.
But it also just flows other places too.
Yeah. Yeah, for sure.
Why not flow to you?
Yeah, I agree.
How do we do that?
If we get the right funnel.
Who's going to do it for us? Okay.
Yeah.
All right, Matt, what's next?
Let's talk about this housing article that I have. I've referenced it enough that maybe it'll be quick.
The Marcus and Eminem.
Yes. There's a few Marcus and Millichap's pieces that I reference that I have included in these notes and that I'm going to talk about right now. This one is about the housing market in general. Really, a lot of it is about single family homes and how mortgage rates have gone down a little bit, and people are kind of coming back to home buying, but not in the numbers that would really give any kind of relief to the buying and selling situation. There's our stronger buying and weak motivations to sell have pushed for sale count to a 9-month low. I think this is notable, actually, and the fact that there's still people who want to buy these houses and that they're stopping now that the price is too high. There's some housing demand that's being pent up there, like we've mentioned, and a 9-month low. That's really low. I thought that we were kind of getting over this because the mortgage rates were high, but no, I guess not. Sales volume of single-family homes is low, 9-month low. I guess this is where we're at right now. I thought things were starting to kind of. It wasn't panic, but this seems certainly a little bit.
So are you saying that it's because of the inventory or because of interest rates, or both?
I think it's both.
Yeah. But
I like to think it's persistent interest rates. Or that's like the kind of cause of this. But what is really interesting is especially for multifamily investors, is the scarcity of entry-level homes for first-time buyers. And you're kind of seeing the corollary in the multifamily market. I've seen a couple articles this past week is, why are they building so many luxury apartments? Well, it's nice when it's new, and it's easier to build it new nice, and then it ages and it becomes a little bit less nice. But that seems like, and it makes more sense to make more money on building nice new.
Oh, yeah, you spend like a little bit more money and you make a lot more. Like, why would you build something that's not as nice?
Yeah.
If it's going to cost the same.
Yeah. Or if you really want to be class apart, it's like people that will buy something new and bury it in the yard, and then it gets a patina, and then you can sell it as an antique. I don't think apartments work like that.
Not. I mean, yeah. No.
But
There's probably. I mean, like a super cool, like
yeah,
historic charm.
Yes, that's exactly right. Yeah. But this is where so lack of entry level homes, and it does have an effect on the multifamily market. And this, I kind of want to reemphasize a subject that we mentioned a couple weeks ago. It's still a worthwhile subject of discussion. I think it's a hotter topic now, I think, than we started talking about 2 years ago. And it's this idea of houses too expensive. Are home buyers becoming renters? And I was always a little bit skeptical of it, and I thought of like, well, if housing goes up, everything in housing goes up. Mm-hmm. Apartments going up, single family homes going up, mobile homes going up. I'm gonna knock that plane down still as I gesture towards things going up. I don't want the plane to take off too. But all these prices are taking off, and they're all taking off at the same time. However, this interest rate situation 2 years ago, that wasn't creating a mismatch between home buying and apartment rents. And so that's this X factor that maybe makes this issue of houses cost a lot, apartments don't. Maybe it's more salient now than it used to be.
And I think we're going to start seeing it now that people are making decisions again.
Yeah.
That the sentiment that it's like much improved, but people are like, okay, I just got to make a decision of whether I'm going to live, whether I'm moving in with somebody or whatever, but I have to have my housing decision, put it off for so long.
Yeah.
And an option of buying a house has just been taken off the table for most, and they're going to be rented for longer. Median age in the country, 33-ish, which is like right when you'd be buying a home. So we've got millions of people that would be a buyer are now a renter.
Well, and remember we talked about this. I was like, where did I? Oh no, we talked about this a couple weeks ago. It was another Marcus Millichap about the median age of renting is going up, and then there was a couple other reports that I kind of had to do some digging into past NAR reports on population trends.
Yeah.
Last year, there was a lot more millennial homeowners than there was this year. Last year, millennials were the top demographic of homeowners or of home buyers. Home buyers.
Yep.
This year, it's boomers.
Boomers are buying homes this year.
Yeah.
What are they doing?
I mean,
they moving?
And I don't know if this is I think it was a 2022 number. Yeah,
but so last. No. Well, that would make sense. Who has the money to buy right now? Who has the cash sitting around?
Yep.
Millennial, like
that's
squares. That's squares. A millennial could have afford to bought a home a year and a half ago.
Mm-hmm.
Now they can't. But the boomers are still, sitting on a big, fat bank account or whatever.
So that kind of proves that out a little bit. Now we always pay attention to things like household formation, and so it muddies the waters a little bit because it's hard to pick out. I haven't seen a specific study that really nails down the effect, the level at which high mortgage and home payment prices drive apartment demand. I'd love to see if someone could figure out, how to kind of disentangle that from the housing prices.
Good assignment.
Yeah. All right, I'll get to it.
You keep out making more work for yourself.
That's right. But I still think that logically, it would seem to make sense. They're not all moving back with their parents. There are some people that want to buy homes, and that is probably continuing to keep apartment demand higher.
Yeah, I 100%. I mean, some people are going to move back in, but some people want to.
Yeah,
but not majority don't.
Yeah, I think so too. And the idea of apartment too. It's like, well, you pay for it for a year. It's not there's little finality to the idea of renting apartment for a year. You can see, and it's about a year, I think, until interest rates will begin to become a little bit more favorable for home buyers anyways. So that would seem to be a very reasonable decision for people. And I also think single family rental market may be the real benefactor of all this. But that remains to be seen.
100%. I think it's a great case for built to rent.
See, and this is what I was positing too last night when I was writing these notes. Is maybe our cultural expectation is now going to be, okay, you graduate high school or I'm sorry, you graduate high school, graduate college, you get your own apartment, then you rent a home, and then you buy a home.
Yeah.
So maybe there, but
that makes sense.
Yeah.
That makes sense. It's
I
like
think so,
another
for sure.
period,
Yeah.
another period transition of like, all right, you need a little bit more space.
Mhm.
You're still like you need an extra 5 years to save up.
yeah.
It's just the reality.
I would and that's exactly what I did with my wife and I, and like it makes sense, you know, you're kind of moving towards that goal, and there's nothing wrong with it.
Yeah. All right, Matt. What do we got left?
Yeah, you know, let's close out with this Marcus and Millichap.
The population trends.
Yeah, or no, I'm sorry. The Marcus and Millichap population trends was the study that I was referencing earlier about. This is a Vimeo, so it is a Vimeo video because, and I will give you this, as far at the time of this episode being recorded, you cannot access this Marcus and Millichap video on their website.
Ooh.
I had to inspect the element, find the video link because there's a problem. No. It wasn't a security thing. There's some glitch in their website, but I got past the glitch, and I'm delivering you the exclusive content that Marcus and Millichap wants to provide.
Only found here.
Exactly.
Not on Marcus and Millichap.
Yes.
All courtesy of Marcus and Millichap. Thank you, John Chang.
Yes, for sure. He did. So this is a really effective video. I think it takes the wind out of the catastrophist sales, as I was saying earlier. Sure, there are plenty of things that could disrupt the banking system. Like we're so vulnerable that a late night texting session among VCs led to the Silicon Valley Bank collapse. So there's lots of things that could spark a crisis because of interest rates making things more vulnerable. But John Chang here shows that there's far less CRE debt associated with regional, medium-sized, those kind of SVB type banks that have been so vulnerable lately. And he really digs into some of the misleading reporting on the issue and saying that, you're going to hear somewhere that the majority of CRE debt is held by banks, or there's a misleading statistic that says that small banks hold nearly 70% of commercial real estate loans.
Well, didn't we see that somewhere in one of the articles?
Surely it has been.
I'm pretty sure we saw that. Anyway, continue.
The real figure is no.
False.
The real fact is that like 63 or some odd percent of debt that's held by banks are hold. So there's lots of different ways that CRE debt is
it's
built.
like a percentage or a percentage type. Yeah.
So it is a little disingenuous. So,
100% of 80% of the time it happens 80% 100% of the time.
Yeah, exactly. Small banks hold about 67% of the CRE debt held by banks specifically, and the category of bank-held CRE debt is such that ultimately the regional banks hold maybe a third of CRE debt, not like 70, more like half that, maybe even less. But that's not as exciting. That doesn't lead to certain doom. I think though. I mean, and this is Marcus and Millichap. They do brokerage, and they are in the interest of keeping things afloat.
They're advisory business. They're selling. They're trying to sell real estate.
Yeah, they don't want to be alarmist, and I think that I am being a little bit more alarmist than they are for sure in this. I think there's still going to be pain, but I do appreciate this is a rare source that actually puts things into real context. And here's a great context here. So these are the estimating outstanding sources of debt. And can you break that down?
Yeah, sure. So from the Mortgage Bankers Association, I could have, if the colors were a little bit easier to read.
Oh, yeah, I'm sorry.
No, CMBS CDO, which is collateralized debt obligation or other ABS. Matt, so that's 38.2%.
No, that was the 16.9.
Oh, sorry. Said 16.9. Sorry, the color blind is coming through. So the 6.9 is CMBS, CDO, or other ABS. So that's like, securitized, bundled, collateralized securities. 38.2% is
banks. Yeah, that's
is banks. 20.6% is GSE. So that's like agencies and whatnot. 9.8 is other.
Yeah.
So it's really, just the banks are really
banks are 38. So if banks are 38.2, and then...
But that's according to the Mortgage Bankers Association.
Yeah.
So according to TREP, which obviously tracks things a little bit differently, banks are like 50%. Life insurance companies are at like 11.9%. GSEs are 17, and other is 6.7. And so now this is all commercial real estate debt. We're not talking about multifamily. Way I know that for sure is because the agencies are over. They're like 60+%.
That's what I was going to say. Yeah, yeah. I was very surprised at how low.
All commercial mortgages.
Okay.
All of them. And so yeah, between 38 to 50% is banks.
Yeah.
So I mean that's a nice chunk, but it's not.
And that's
it's
all
not,
banks.
It's not 70. It's all banks.
So
all banks.
So really, it is closer to like 20 or 30.
But then this 16.9 or there's a line here. See, this is not colorblind.
I know. I gave you the worst assignment.
Matt, Spencer, can you figure out the color? There's a line. There's a line there, Matt.
Yeah.
Sorry. So there's some number, but 16 point. What's the life insurance companies, Matt? You tell me.
Yeah, 14.4.
14.44. Are these two different colors to you?
Yes, vaguely.
Vaguely?
Yeah.
My God.
They're in the yellow green.
I don't know why colorblindness has not been added to the American Disabilities Act.
I know.
Got to put if I want to put something up on the second floor of a clubhouse, I got to put an elevator in or a ramp.
Yeah.
But they're not. I can't see the graphs on the Marcus Millichap report.
It's a good point. So they should put stripes or something.
Exactly.
Yep.
Exactly.
I'll keep that in mind when we make a.
I'll have to make a note.
Yep.
Make a note to them.
But
That's
yeah,
great.
So I think that ultimately the message of this was less about it was kind of reassuring to against the idea of CRE failures kind of being a contagion to banks or of banks being suddenly like kind of falling, or of
systemic. Everyone's systemic risk. And now commercial real estate's going to come next. And John Chang, and I read his LinkedIn post as he released this, and he's like, I saw the statistic, and he's like, that doesn't sound right.
Yeah,
he's like, I had to dig into and get to the numbers.
That's what really
very passionate about.
And that's what
I
really
want to get to the
motivated me
bottom of this.
Yeah, I also really appreciated that idea of like, you see things and we see things all the time. We saw that, you see the things in Wall Street Journal where they're trying to give short shrift to rent growth, and I'm glad that we're kind of here to clarify. And
our best.
Yeah, that John Chang is doing it as well.
Yeah.
So you get the commercial real estate lender composition here. The biggest category of any of these, the way they slice them, is the regional local bank, but it does not represent a dominant form of the lender composition.
Except in 2020, shifted a little bit, which makes sense because a lot of the banks weren't lending.
Yeah. The government was a big part of 2020, but typically, it does seem like the regional banks are
CRE loans default in mass. Oh no, the lip read. No, I don't think so, Matt. Really, that's a bad John Chang impression. I can do it. I think I can do it. Okay, I'm gonna hear my John Chang impression. I can't do it.
Yeah, he doesn't have
like. I mean, he's got a great voice for this, but it's not like I just can't do it.
Just actively convincing and compelling.
He's like, I'm really smart and I know a lot about multifamily and I'm an economist.
Yeah.
I think I'm just use my voice.
That's pretty good.
Anyway, Matt. Who would be good, or is it a bad idea to do impersonations of people we want to come on the show?
Yeah, I think this is probably pretty close knit. I don't want to step on anyone's toes here, but there are people that I do kind of mythologize in the.
I thought about introducing myself as Jay Parsons today.
Oh, that'd be great.
Yeah.
Yikes. This is very revealing. This section of his video where he talked about the estimates of CRE debt coming due. Some have it at 400 billion. MSCI TREP has it at 448 billion. The Mortgage Bankers Association has it at 728 billion.
Oh, there's a little bit of a gap there, I'd say.
And it makes me think like where are these guys coming up with their conclusions? What kind of data do they have, and what kind of speculations are they making? Because you don't get that amount of variation without some form of opinion, I think, coming into it. They're crunching the numbers and they're making some kinds of expectations, based on something. I can go to the census and go to the Bureau of Labor Statistics for a lot of hard data on things like completions.
Not all these loans.
Yeah.
Originations. I mean, because that's a $400 billion versus 728. That's a big difference. Now, but maybe they are just accounting for things differently, and MSCI just doesn't take into account certain types of.
I mean, and this is.
I would have to assume that the Mortgage Bankers Association aren't making things up, and so they just are aware of more data.
Well, and this is some of the the stew that's going into the foggy outlook in the multifamily market. No one knows enough.
Exactly, Matt. I mean, there's not a probably better example of like, let's figure it out, and then you see this, and you're like, these are the people that are supposed to know, and they have wildly different. It's not even like it's estimates of CRE debt coming due in 2023.
It's like you're playing poker.
They don't know.
You're playing poker. You either have a pair of aces or a pair of sevens.
Yeah, and then are you paying attention to what you have or what the rest of the table has, or the cards in front of you?
Yeah.
Or in the ranges, whatever is range.
It's a big range. That's almost not quite double, but still big enough to really highlight the fact that people are taking action or not action. And I just to go back to it, I think the real emergencies, they're people that are real. They're going to be in trouble for a very short amount of time. They're going to get out as quickly as they can. And the market that I'm really think is going to have sustained losses maybe is the office market. But that's my I'm gonna do a lot of reading this next week and really get grips so that I can pull myself back from this.
And there will be some, I think, multifamily markets that like will be exceptional. I hate to say like losers, but there will be some pain, and it's the sexy markets that people have been talking about the last couple of years. I mean, I know like just saw an article, I think Bigger Pockets did a report on Austin. I think Blake sent it to us earlier today. I mean, Austin, there's a lot of trouble brewing. I mean, they've got like 40,000 units in the pipeline coming due, and rents are declining.
Yeah.
Occupancies are declining. It's like it and again, like Austin over a 10-year period versus Austin over the next 12 months is a very different like investment thesis, especially then you look at, well, there's a lot of people that just bought at the top who were like, well, everyone's still moving to Austin, so I think it's I mean, I just remember hearing these pitches of these young guys that were going to buy a multifamily deal, and the whole thesis was, Austin's just continuing to grow, and we're buying in a 2 cap, but and we're buying under bridge loans, so we'll be able to we'll be able to refinance, and we have to refinance, but there's going to be growth, and all is going to be good. Like if they did, I don't know if they did that deal or not, but if I wish them the best, and Godspeed. I hope that they have emergency supplies. I don't know.
Well, and
emergency blanket and extra water.
And if I can,
iodine tablets.
yeah, for sure. Because there are, and last week the Cushman & Wakefield had a report on like developers' risks.
Yeah.
And it was basically like talking about how some of these markets that are getting new supply, some of them will eat up the new supply with growing apartment demand, but a lot of them are coming in and the momentum is not going to carry forward in the way that people want it to.
And again, will you get that growth over a decade? Sure, but if you got the loan coming due next year, you're not gonna get there. You can be right, but get the timing wrong, get the direction right. But
and I may be wrong, but these smaller markets, they'll be okay in 10 years, but they get a huge amount of new supply, and it's going to take them all the longer to recover.
Matt, I'd say there's a lot of uncertainty right now. There's been, but that's why we created the Gray Report in the first place to do this, to help understand, quantify some of the stuff that's happening, changing on a daily basis. And we've been kind of, born and bred in this environment.
Okay, I'm going to say this, and I don't mean to talk ahead of you. There is a lot of times where I'll say, oh yeah, and I've said this before. First time we say it, we're not really sure of ourselves. This is a trend we're starting to see. Second time we say it, it's getting a little bit stronger, but we're still keeping our eye on it. And then the third time, we're really, we've been ahead of this, so we will follow these trends.
I don't like to assume that, we've got all the answers, because like we don't. We started this show because we're like, we don't have the answers. Let's figure it out. Let's talk about it. Looking back, we were looking ahead, and we were able to point out a lot of things that were happening. In many cases, months, not many months before they happened.
Yep.
Again, like I think that the whole prediction game is one that we don't really want to be in, but talking about just what we're seeing and what it could mean.
Yeah.
But I do think the things we have talked about and way we were seeing that they could go, a lot of that has played out.
Yeah.
I'm sure not everything.
One of the most gratifying things has been watching these trends kind of firm up as we track them. It's like, all right, well, maybe we are doing something that's right.
Or at least, on the pulse.
Yeah.
And I think that's important. And again, whether it's inflation, whether it's, how long inflation is going to be, whether that there was an opportunity to, buy apartments with rent growth, when no one else, believed that the type of growth was happening. We were just talking about the data that was coming out and supply and just what was going on from not only from a national report standpoint, and maybe this is what makes it unique, Matt. Not only taking the data from national, regional, and local data sources, or combine that with anecdotal observations that we're seeing, not all anecdotal, it's true observations that we're seeing in our own portfolio, because we're actually practitioners of this. We're not just talking about it. We're not just making content, even though this is great. We do this, and it's a part of the job. But our real job is buying and managing and operating apartments, raising money and capital and all debt for all that to make that work. So we're doing it. It's not theory or we know somebody. But then we're really well connected in with other owners, operators, industry folks, all the research people too. So we're getting a lot of anecdotal information, I guess sentiment. Then we're also getting some smart opinions from researchers, and then the actual data, and trying to put it all into
and like you said about good traders, we'll pivot if we have the wrong assumptions. It's in our best interest to say, okay, we're wrong. We're going to stop losing money now.
Yeah.
And not that we have, but there have been times when we've changed, assumptions, and that's led to us getting more opportunities and things like that.
Or avoiding pitfalls.
Yeah.
I there's probably more pitfalls that we avoided last year than necessarily opportunities. Right now, because of what we've seen, changes we've made from our acquisition criteria, we're not really doing any deals. I want to do a lot of deals right now. It'd be great. But we've shifted, and returns that I would accept a year ago aren't returns that I would accept today. If it wasn't for this information, it'd probably be, status quo. I know a lot of groups similar to us, friends of mine, who kept the status quo last year, and they're looking at, $150 million of CRE, debt on bridge loans and stuff. We're not dealing with that, man. So good stuff. If you want to learn more about what we do at Great Capital, pop on over to the website, greatcapitalllc.com. We've got the best newsletter in the biz, greatcapitalllc.com/newsletter. We've also got, Matt, the world's best multifamily intelligence aggregator. Greatreport.com.
Go on it. You'll learn.
Check it out. But most importantly, if you found this valuable at all, first of all, thank you, and we appreciate you for watching this whole video. Geez, you do have some patience to deal with us.
Love it.
But subscribe, leave a comment below, give a like if you are so kind. But in the comment, be like, guys, you're not getting it.
We have to respond to a comment. There was a comment, and we talked a little bit about regional banks, and the comment was from a couple weeks ago, and you'll be able to find it just really quick here.
Matt, watch one of our own videos here, but 25 basis point rate hike. What breaks next? It was a video that we put out not too long ago. Looks like it was 13 days ago.
Still relevant.
Christian Rooney comment 12 days ago. 2 comments actually, so we really appreciate the 2 comments. 2 is better than 1. Which came first, Matt? Next pod?
No, he said he put his first one, and then he was hoping that we could address it in the next pod, and then
it would be great to hear about what would happen if regional banks tighten up. I think they have 67% of CRE loans. Next pod.
Hey, look at that fact.
I think we covered that a little bit.
Yeah.
I think we covered that a little bit in talking about John Chang's piece.
They have about maybe 30-ish%.
Depends on who you ask and how you look at it. And so what is going to happen? We're already seeing a little bit of this, is just the credit is tightening. The spreads have blown out because of the volatility. And so what a bank charges on a loan, there's the base interest rate. That's what they're borrowing at, more or less. And then they're going to tack their profit on there. So like, like
so
the rate,
tacking on more now.
well, exactly. So instead of tacking on 1.5%, they're going to tack on 3%.
Okay.
And because they're pricing in more risk, hey, I need more premium, there's risk. Same thing we're doing, in the sense of like, I need more cash yield because there's more risk. Can't get a 4, I need an 8.
Yeah.
So it's the same thing. So it's what would happen if they tighten up? Well, they are tightening up, and it would be the spreads blow out, and it'd be harder to finance, and prices would eventually go down a little bit more because it's going to be just harder and harder to finance a deal. It also may make the agencies that much more attractive, and so maybe you're not going to go to the regional bank. Maybe you're going to go to an agency if you're a multifamily lender. If you're a commercial, office, not necessarily an option. You don't have FHA loans.
I wonder if that does check the regional banks a little bit from bumping up it specifically in the multifamily category.
Yeah, it will.
Yeah. Okay.
Yeah. No, I think a lot of the multifamily stuff was not necessary. It's vast majority is agency.
Yeah.
Then some regional banks and bridge debt. A lot of private lending also, debt funds and things like that. I think Meet Kevin and I generated the same AI-generated money printer, although, or very similar. Is it when I put it on Dolly to make a money printer of the future, it's a very similar. It was not the same, but it's very similar.
A lot of flame. If I need I need to talk to him. Who's photoshopping the flames into Meet Kevin's thumbnails, because he's got a good flame or a mushroom cloud every week, and dang if it's not just so pleasant to look at.
Teach their own, Matt.
Yeah, exactly.
Thank you for watching The Gray Report. We're going to be back with you every single week. Matt, great job last week. Although, by the way,
thanks.
you and Ads have really held down the fort. It was fun.
Nice
I know I watched the episode. I thought it was really good. I'll have to go on vacation more so you guys
all right, good. Yeah.
do it.
Well, we can handle it a little. We were really nervous. So I don't know if you saw, we were sweating bullets. We were so nervous.
You guys got it. You guys are good.
All right.
I could see on your intro video.
Oh, I was squirming in my chair like a toddler.
I didn't watch it I watched it without audio, and so I was just watching you, and I was concerned. But the audio made a lot more sense actually. But I was like, you were making me nervous.
I know. I should have just cut that out and retake it. Oh well.
It's all good. All right. Well, we'll shoot one here. All right. Thanks, guys. Watch the next one. All kinds of stuff we're going to be putting out. GrayCapitalLLC.com. Hasta luego, man.
All right. Yeah.